Facebook. Page. That takes. Very good.
Hello.
Hello, Facebook world.
For those of you who are getting signed in, thanks for finding us. Thanks for clicking on us. We'll be getting started here in just a few minutes. So if you're on Facebook, you get to be part of the early crew that gets the inside peek to the Keystone Financial Studios.
Keystone Financial Studio. I love that term.
Coming to you live from the Keystone Financial Studios in the land of love, Loveland, Colorado.
Absolutely.
So you get to have more fun with us if you come in early.
5 minutes till we begin. We'll let everybody start joining in as we come.
Yep, absolutely. So thanks for tuning in. Grab your beverage, your snack, your lunch. It's funny, early part of my career, we used to do brown bag presentations back at Hewlett Packard way back in the day, but brown bag presentations. So people would bring in their trays, they go get their lunch and bring in their trays to the meeting room. And then we talk about a financial topic like this, and we still do this, right? But now we get to talk to you wherever you are, even if you're traveling, vacation, if you're a snowbird and you're not here in Colorado right now.
Save it for later.
Yeah, glad you're here.
Absolutely.
Yeah, technology is good.
Today's topic is your employer-sponsored retirement plan.
Mhm.
In other words, a 401k or a 403b. Quite a few things, actually.
Yeah, but 401a,
included in
there's
that,
a whole
yeah.
alphabet soup of different retirement plan options
Right.
out there. A TSP, if you don't recognize that, it means you probably don't have it. Or if you're a railroad employee, they've got their own retirement system. It's weird, you've got all these different acronyms and things. So we'll be talking through those. Just know that some of the terminology, it may not be familiar to you, but more than likely it kind of translates to something that you already know. So we're definitely going to be digging into that, and any questions you've got, we'll handle individually after the fact as well.
Absolutely. And also remember too, that this could also be for self-employed individuals. So you don't necessarily have to work for a company in order to have a 401k.
Yes.
A number of ways around that too. And actually self-employed individuals get some pretty good benefits in that regard too.
Yeah, for sure. Yep. So there are definitely options out there, but just glad you're here. Glad that you're giving us your time today. So we'll give people a couple more minutes. For you who are on Facebook, welcome. For those of you who are popping in on Zoom or on any other way you were able to find us, glad you're here. So after the fact too, we're going to be recording this. We are recording this. So after the fact, you will have the ability to go back and watch this. And we especially appreciate it if you share these to other people that might need help, that might want to learn about this stuff. That's a really effective way to be able to not only help them, right, but also to be able to get the word out if you like us, in other words, and you want more people to meet us, know about us. It's a great way for you to be able to introduce them just with the educational topics, in other words.
Absolutely. I think that's one thing I love about us and here at Keystone too, is just the educational content that we try to put out.
Yeah.
A lot of this stuff, obviously we're in the industry, so a lot of this stuff makes more sense to us because we live in it every day.
Yeah.
But I've talked to plenty of people, friends, family, et cetera, over the years who topics like 401ks, can get pretty complicated pretty quick.
Right.
So,
yeah. And more than anything, we want you to be able to make an informed decision. That we want to make sure that, because ultimately all these decisions, even if you hire somebody who's a fiduciary, investment advisor, financial planner, whatever you want to call us, or call somebody else that might do something similar, ultimately they are your decisions, but we want to make sure that you're not just winging it. And my experience being in this industry for 24 years now is that most people are winging it.
Yeah, I would agree.
But most people, they do what their coworker said, or what their brother-in-law, did last year when he retired, or something like that. That's not a good way to make a decision.
Absolutely.
No.
Yeah, better to go in informed and know what's right for you. And that's the thing too, is these plans, they're set up to feed a lot of people, right?
Yeah.
And to be used by a lot of people, but it doesn't mean that one thing is correct for everybody.
Yeah. Yep, for sure. So as we hit the top of the hour here, again, this is going to be recorded. And when we hit the top of the hour, we'll do a grand announcement that we're here in the Keystone Financial Studios. So we'll be watching our time here and starting in just a moment.
And that's the top of the hour, actually.
Yeah. All right. Well, welcome everybody to the Keystone Financial Studios here today. Thanks for giving us your time. For those of you who are watching this after the fact, welcome to you too. We're always here to be educators, not just financial planners or telling you what you should be doing, but also helping you understand, at least helping you enough, helping you to understand enough that you're able to make an informed decision and not just winging it. So that's important because this stuff, most of these people don't really have a do-over when it comes to planning for retirement, especially if you're close to retirement or in retirement. You know that there really is no do-over. You're probably not going back for a second career, or that may not even be an option at this point. So
Absolutely.
it's pretty important stuff. Just glad you're here.
Yeah,
Yeah.
welcome to it. Today's topic, employer-sponsored retirement savings plans. If you happen to be watching this live, we will do a Q&A or have an option for that. So please use the Q&A function you'll find at the bottom of your screen. Otherwise, as always, we'll open this up to any other personal questions, things like that. Each of our emails and whatnot, contact Keystone with any questions specifically to you or your plan.
Yeah. And if you're not sure who to contact, just email communications@keystonefinancial.com. That will get to our team and we'll get back to you very quickly. So yeah, glad you're here. As we start out here, you'll notice the title slide here, Plan Now for the Life You Want in Retirement. That's particularly important because a lot of people don't do planning. They really don't plan ahead. They just kind of get to retirement by accident, and then they've got what they've got, right? And their plans, their different resources, they might have their house paid off or not. They might have loans or not. All the different things that come into this is very individual based off of you. But we much would rather help you plan ahead and really make this very individualized based off of the retirement that you want. And not just the amount of money, but the amount of money is only there to produce income. People don't invest in stuff just because it's fun. Most people don't anyway. Most people want income off of that investment at some point, whether that's a retirement plan or any other type of investment.
True.
Yep.
Absolutely. That's what it's there for. So,
yeah.
And we can use things throughout this if you're just starting out or if you are near to this as well, near to retirement. So still things that we can do. Right?
Yeah, it's an important topic. We oftentimes like the word financial freedom, by the way, better than retirement. So if we use those terms interchangeably, they actually do mean different things because we do have a lot of clients that are financially free, meaning that they know they could retire. They know they're continuing to work in their business or their company. They're doing that by choice at this point. But it really is a get to versus a have to. And we're not quite at that point yet. So Jeremy and I are diligently building our wealth. But for those of you who are financially free, congratulations. For those of you who are planning towards that, we certainly want to be a part of that as well. So let's dig in. Retirement, a new beginning. It's certainly for a lot of people, it ends up being something that's exciting, but also can produce some anxiety. I can only imagine. We've gone through this with a lot of people, hundreds, probably thousands of people over the years that I've had these conversations with. And more often than not, no matter what the dollar amount is, by the way, it could be, millions or tens of millions of dollars. There's still some level of anxiety with that because you're not going to be producing an income anymore. Maybe you don't have that safety net of that next paycheck coming in, or again, if you're a business owner, that you've got that revenue coming in, from your product sales, from your services, whatever it is that you're producing right now. There's some sense of security, I think, and also a sense of purpose with it. I love what I do. I think Jeremy loves what he does, right? Absolutely. You still do?
Absolutely.
Right? Good. Yes. As of today, we still love what we're doing. Love what we do. So because we get to help people, really, the planning process is something that, it's dollars and cents, but it really does come down to income, and income is there to produce security and financial security just to cover the basics, but it's also there to cover the stuff that you want to do. I think for most people, their idea of retirement isn't just to go sit.
No, I remember thinking back to when I very first became a financial advisor. I used to love having these conversations. People say, what does retirement look like to you? What does it look like? Are you sitting on a beach somewhere? Are you hanging out with the grandkids? Or is it just you're waking up and there's no alarm clock waking you up at the beginning of the day.
Right? Every
right?
day is a
You get to
weekend.
do what you want to do. So
Yeah.
that looks a little bit differently for everybody.
Yeah, absolutely. As you can see, we have examples of happy retirees that are financially free, right? As you see these happy retiree photos, yeah, it might be grandkids, and these are cheesy photos, obviously, but the reality is people do want to do stuff. Most people don't just want to sit around and just exist. And most people have some idea of their bucket list, the people that they want to spend time with, create memories with. It might even be the people that they want to support to make a difference in people's lives, right? Through charitable endeavors or spending time with grandkids. It's kind of fun because we get to hear all these stories, right? Of how people are spending their retirement and what that looks like. But there's usually some transition phase. There usually is that kind of period of time of people figuring out the new me, the new reality of not going to work every day and having that be part of the finances or just kind of personal life, the relationships, all the things that come into that. So we do want to always acknowledge that there's an emotional impact as well here. This is not just about money.
Absolutely. Really, it talks, so I think this is a good place to start really is, how long am I planning for? Right?
Yeah.
How long is this retirement going to be?
Hopefully a long time.
Hopefully a long
Yes.
time, right? That's kind of the approach that we take to it, is that we're gonna plan for as long as possible. In a lot of this. So what does that look like? Is it, 10, 15, 20 years plus? Absolutely. Hopefully everybody's in that 25 plus range.
We hope so. And if you just do the math, you figure the average person, probably retires somewhere in the 60 to 65 range. Some people a little bit longer, but I think that is the average. 65 for a lot of people is kind of their trigger point because Medicare kicks in. For a lot of people, they say, I want to make it to that age because then my medical costs, my out-of-pocket medical costs at least will go way down. So for a lot of people, that is kind of the trigger age is about 65, maybe a little bit earlier. If you do the math, well, you plan on making it to 85, 90 years old. I think for a lot of us, I am. I mean, I definitely plan on being around and hopefully, of sound mind, all that. You want to be in good health. But a lot of times when we talk to people, they have a positive vision of later in life, but a lot of people have negative vision as far as, well, my great aunt, blah, 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 the last years of her life were not good. And, she was in a nursing home or whatever it might be. So, that's part of taking care of ourselves and hopefully good genes, all that stuff, medical advances. We want to think positively for sure. Is that if we're around, we still want to have choices. We still want to have financial security.
Absolutely.
When we do have clients that are into their 90s and still doing stuff and still very independent, actually. So just imagine what that'll look like. If you're retiring right now, just imagine what that might look like in 20, 25, 30 years for you with some of the medical advancements and things that they're talking about. And hopefully some of the diseases, even Alzheimer's, Parkinson's, they're making some progress on. And hopefully we'll be able to completely lick by the time that you or I or Jeremy, any of us kind of get there at this point. So we definitely want to plan for a long retirement because that is the number one fear of retirees. We know that from studies. We know that from talking to people. That's the number one fear of retirees is that they're going to run out of money sometime in their retirement. And, that's for a lot of people that creates some anxiety. So we want to be the antidote to that. We definitely don't want people to be stressed in retirement. That's not the point.
Absolutely. So how much do you need? So we've had this conversation with countless people, right? For somewhere, I don't even know where it came from, or somewhere along the line in our industry, someone said, you know what, you can retire on about 70% of your income right now, and you should be fine. Since day one, I've always wondered where that 70% came from. We don't really see that as being the reality, do we?
No. Especially in the early years because of that bucket list. I think for a lot of people, they kind of in their mind, they kind of have these dreams, or if you're married, you might have as a couple have these dreams of things that you're going to do after retirement. Maybe you've been kind of saving up some of these experiences, wanting to go on a cruise or wanting to go spend time in the wintertime someplace warm, want to play a lot of golf, whatever that looks like for you. We're excited for you. We're excited for you and want you to be able to have those experiences. So for a lot of people, they do end up spending maybe more. I mean, even in the early retirement years, they might actually be spending more than they were spending before.
Absolutely. I would say at least, we see the lifestyle basically carry over, right? So what you're living on now, you're basically going to want to be living on in the future, especially if you're retiring 65 or earlier, and we're not necessarily starting Social Security right away as well. There's going to be some gap years there where all of the income you're due is not necessarily coming in,
Yeah,
right?
it's true.
And you're newly retired, so you have bucket list items. And so those first few years, those are probably some of your most expensive years in retirement. So it's not unlikely to be spending more than 100%.
Yep. And the one thing to kind of differentiate here too is the fact that in some of these studies, that might be why these numbers are so wildly different, is that some of the studies might be looking at needs-based as far as, well, what would you have to survive? But again, who wants to retire and just survive,
Just
right?
survive,
And just sit around. People do want to do stuff. Maybe you've got hobbies that don't cost very much, gardening, things like that could cost a lot too, depending on kind of how you garden, right? But
Absolutely.
yeah, but if you like to ski, you're probably going to want to ski more. If you like to golf, you're probably going to want to golf more. If you like traveling before, you're probably going to want to do a bunch of that, especially if you're still, young and healthy. And, those are kind of the go-go years where people want to, if they can, they want to be able to spend and have those experiences.
Absolutely. And then the other key fact here is going to be inflation,
Yeah.
right? Which, as of the recording of this, inflation is a lot higher than your typical average. So, we can look at the last 100 years, in the stock market. And over that 100-year time, we've been through multiple wars, lots of things going on, lots of different, presidents and congresses, et cetera. Long-term rate is still at about 3.1%. Okay. Right now, as of this recording, it's just north of 6%. Right. So trending down.
And it was a lot worse than that. It was like 10% not that long ago. So
absolutely. Back in the 70s, of course, it was even bigger than that. Right. So we lived through that, but that 3% is still a pretty good long-term average when we look at it.
Yeah, it's kind of funny. We used to have to show people these examples a lot and remind them that, hey, inflation's a thing. Right now, you don't really have to tell people because you see the price of eggs or plane tickets or whatever it is. Tank of gas. Things have gotten much more expensive in general. Now some things have gone down. If you're going out and buying a flat screen TV or something like that, it's probably true. That's cheaper maybe than it was a couple of years ago. But in general, we definitely are seeing people feel more of the effects of inflation because it's been so high, so much higher than normal, in other words.
Absolutely. So that's one of those things that we kind of have to build into retirement planning, right?
We do.
That inflation factor.
Yeah, we do. It used to be when people retired, they used to be able to live off of a fixed income. Well, that was because people didn't live very long. If somebody retired, say 100 years ago, if somebody retired at 65, how many years would they have after that? Probably not a lot. I mean, the life expectancy wouldn't have been more than a few years for the average person. So now we've got people retiring, sometimes even in their 50s. People retire.
Absolutely.
That could be a good 30, 40-year retirement. Easily, right, with cost of living increases. So remember, with inflation, it's not it's not some lofty concept. This is the fact that you need more money every year to be able to buy the same stuff. In other words, to be able to still buy eggs. Otherwise, if you had a fixed income, say over a 20, 30, 40-year period, either you're going to run out of money sometime, or every year you're going to have to cut back on your lifestyle. Actually, every single year, again, that does not sound attractive. Basically, my life is going to get worse every single year. Financially, I won't be able to spend as much on stuff. Again, that's not attractive. So we want to build that into the plan.
Absolutely. So really, then, how much does it take, right? And again, this is a factor. There's a couple of factors go into this. Really, it's a matter of how long are you planning for, right? Are we planning for 30 years? And then how much do you spend? I think that's the biggest thing, and that's the probably biggest conversation I think that we have with clients in pretty much every planning meeting, right? All right, how much are you spending? How much do you want to spend? How much can you spend based off what you have? So,
and a lot of times that is the question that people have, again, because they want to go do stuff. For a lot of people, that is what they're asking us, is how much can I spend without screwing this up? Basically, how much can I spend without running out of money?
Easily. Absolutely. So really, it's, how big of a nest egg do we have to have? Now, obviously, a lot of this depends, like we were saying, on that inflation factor. So we'll say about 3% for that. But what this slide is showing you right here is actually saying a return of about 4%. So if we, again, go back 100 years in the market, we can see that a well-diversified portfolio, so middle of the road portfolio, not even aggressive, should average about 7% return. And so really, depending on how aggressive you are or are comfortable with being, can actually change these numbers as well, as far as how much you need and what you're going to be striving for.
Absolutely. And so the example here, again, a 4% rate of return with 3% inflation, that means we're actually gaining only 1% a year in real return. And a 4% rate of return, again, historically, because we can't guarantee anything, right? This is all based off of past performance, past index returns and things like that. But a 4% return, that would be probably an investor that would be really conservative. Right now, we can buy treasuries for over 4%, right? Just on the yield alone. So historically, this would be a really conservative investor. And you might be looking at this and saying, I don't have $3 million. This is a problem.
Right.
Well, if we rerun the numbers and we used a 5% rate of return or 6% or 7% rate of return, we spend a lot of time, and for those of you who are clients, you know this, we spend a lot of time talking about your risk number, and your risk number is your kind of preference as far as how much risk you're taking in your portfolio. And there are ways that we can help you arrive at that. We've got tools, right? So you don't just have to pick a number off a bus. You can just actually go through some different tools to help you arrive at that. But that risk number is going to be critical as far as realistically, if you've got this risk number, what does history show us? In other words, as far as what that can produce in returns over time.
Absolutely. Gives you some realistic expectations as to what can happen. Really, the key is finding that risk number that allows you to get the maximum amount of gain but still help you sleep at night. Right. So you don't want this to be causing you stress by any means. You want to have a fun retirement.
Absolutely.
So then the other key is, what other sources of income do we have, right? If the 401k is literally your only thing that we're doing, that's one thing, right? But we have to take into account Social Security. If you were a teacher in Colorado, you probably have para, government employee. Government employee for the federal government, TSP. So lots of different things out there, right? That depending on where you worked and whatnot, you have access to.
Right. Yep. So there's all kinds of things that you could have besides Social Security. And I'd say it's less common now. It used to be very common, say decades ago, that you'd have a company pension or something like that. Almost no companies offer pensions anymore.
It's pretty rare now.
Probably is. Yeah. If you're a government employee, you may have a pension, but that's going to be about it. They used to have the three-legged stool concept of planning for retirement, that you get your pension, you've got your Social Security, and you've got your savings and investments. Over the years, one of those legs has kind of gone away for most people. So now you got two-legged, right? And Social Security, most people don't exactly feel good about that, right? Because of the way that it's funded and the fact that it hasn't been fixed. And even though it's been well known that it's a problem over the last probably 4 decades at least, but they haven't fixed it. And so it means a more dramatic fix is going to have to happen someday. That someday is getting closer and closer. So that's kind of a shaky leg, we'll call it, Social Security, which means savings and investments, like your own resources, in other words, probably are going to be the lion's share of what's going to produce your income.
Absolutely. So the more we can plan for up front for that, probably the better. And really, the one thing I think I like about this is, Social Security. It really was. It was designed to be a safety net, right? Social Security was never designed to be, hey,
1930s, people were starving to death.
Here's your cash. You can retire on this. You'll be good to go. They knew it was never going to serve that purpose. Somehow over the years, I think it got muted. A lot of people kind of thought, I got Social Security, I'll be okay. Right. Well, you're not going to live that great of a life on Social Security alone.
No. And again, the program was fundamentally set up different back then because you could start drawing it at 65, but I think life expectancy was 67, something like that. So literally the program was only supposed to provide maybe a couple of years of income. Now you've got people that could be starting to draw it in their 60s and living into their 90s or 100s and still taking that income. So it's not solvent. That program is not solvent. So especially for our younger clients, a lot of them tell us, don't even figure it, like leave it out. Don't even figure it in our numbers. We just don't want to count on that being there, which, it's probably good because oftentimes the government's not a very good manager of assets and programs. And so something that you can't control, something that Congress could just change down the road, it's probably better that you don't heavily rely on that for your retirement income.
Absolutely.
Which means that we need to start planning. Right.
Yes, indeed. So
as early as possible.
Yeah. So for some of us, for younger generation, whatnot, it's a lot easier. Let's just say that the younger you are and you start doing 401ks, building up any kind of retirement accounts, it just takes a lot less, right? It does. It's a lot less painful on the pocketbook. As you get closer to retirement, the older you are, the less time you have between working and retirement. Obviously, you can still do some things. It just takes a little bit more.
Yep.
Right.
It does. And we hear that repeatedly from people over the years, and it doesn't even matter how much money they've got.
No.
They might have nothing, they might have millions, tens of millions, and they all say the same thing. Gosh, I wish I would have started earlier.
Every single one of
Just
them.
because it does make it
Yes.
so it is a snowball effect, right? With
Yeah.
compounding. Yeah. So it really is huge. More time you give yourself, and certainly for those of you who are younger, maybe just starting out your careers, I'm sure we're probably not the first people that have told you this, right? That
Mhm.
you should sign up for your 401k right away, sign up for some type of a savings plan right away, because developing that habit early on is important. It's important not to wait, because naturally, I think what people think, and it kind of makes sense, right, is that,
Mhm.
well, I'll do that later, right? I mean, that'll be something that I do after I, buy my first house or something like that. And then
Yeah.
the years go by really quickly, as I'm sure you would all agree. The years go through a lot quicker than you would think. So just kind of forcing yourself. It's kind of like if you had a tax, let's say the government said that we're going to raise your taxes by 20% right now, we would all kick and scream and protest and whatever, right? I mean, there'd be uproar, and what would we all do? We'd pay it. We would, right? We would pay it, because if you don't, you're going to go to
Yeah,
jail,
because what
right?
else
Yeah,
option do you have?
exactly. So we kind of have to, and these are mind games, right? But we kind of have to we'll think of it that way. Whatever the percentage is that you decide on, whether
Yep.
it's 10%, 15%, 20% of your earnings that you're putting away for yourself. In other words, you're not losing the money. It's for yourself in the future. You really almost, and I'm doing the same thing, right? We all have to kind of treat it as a tax. But it's something that's mandatory. It's not something that's optional. And naturally, what'll end up happening is you learn to live on it, right? Because that money just goes away, and you learn to live on it. So that is one of the key benefits of participating in a company retirement plan, because your employer just kind of pulls the money out. You don't actually see the money. So let's talk about that. Why we want to save through a retirement plan. Convenience purposes more than
Absolutely.
anything, right? Because you don't have to think about it. It's just automated.
Yeah, if 401ks were set up where we had to every month go in, log into a
Mhm.
site, push $100 over,
Mhm.
5% or whatever that is, push it into this account, vast majority of people would not do it,
No,
right?
human nature. You're going to forget, or it goes to time to log into that website and click the button. Oh, but that's right. We got this coming up. We've got this soccer fee. We've got this vacation coming up.
Right.
Well, let's wait a few months, and then we'll start doing it. And that just doesn't happen. I think you would probably agree that human nature, that money is always going to find someplace else to go.
Absolutely. It'd be way too easy to find
Yeah.
another thing coming up, next thing on the horizon.
Yep.
But then you also have the tax advantages
Mhm.
of doing this. And
Yeah.
so depends on, most plans have a pre-tax option.
Mhm.
That's kind of where everything started. A lot of plans nowadays, if not most plans, have a Roth option as
Mhm.
well.
Yeah.
So you can take it out, let it grow tax-free for your future. And I think most people are probably somewhere doing both.
Yeah.
Right. And
I'd
so
say the average
um,
person probably does a little bit of both.
absolutely.
Mhm.
And I
Yeah.
think we have that conversation with clients all the time is
Mhm.
how much should you really be putting into that pre-tax portion?
Yeah.
How much benefit are you getting from that on your taxes now versus in the future?
Yeah.
So that's one of those conversations. It's ongoing. What makes sense? What
Yeah,
doesn't?
it's based on each individual, but a lot of it does come down to what your overall income situation looks like.
Mhm.
Because if you're in a low tax bracket, you're probably not getting a lot of tax advantage from doing a pre-tax retirement plan anyways. So
Yeah.
doing a Roth probably makes more sense for somebody who's in their highest earnings years. Maybe they're just a year or two away from retirement. Maybe Roth isn't as beneficial. It could be that they're putting that money into the traditional to get that tax advantage. So, and some people just hedge their bets and do a little bit of both. So,
Especially if and if you're in that
Mhm.
high, you're a high earner,
Mhm.
that's this is probably one of the only deductions you actually get.
Yeah. It is.
Because if your income's high enough, you're disqualifying for a bunch of other ones that are
Yeah.
out there.
Yeah, for
Just how
sure.
the tax code's set.
Yeah, and then of course, investment choices, we want to dig into the investments. Once the money's in the plan, in other words, once it's in the 401k, now you've got investment choices. So they don't do that for you typically. So you have to make that
Mhm.
election, or some plans actually have a default choice. We'll talk about that as far as where that money goes once it's in the account.
Absolutely. So kind of going back to the convenience, making the automatic payroll deduction.
Mhm.
I think the biggest thing, especially for younger clients, and I've had this conversation with older clients too
Mhm.
that have kids who are getting
Mhm.
their first
Yes.
job or
Yeah.
whatnot, and it's how can I convince them to do this? and talking to younger clients who are just starting out or kids, and they say, well, I really need every dollar of that paycheck, right?
Yeah.
I got student loans, or I got this, or I got that. But even just kind of starting out at a 1 or a 2%, right?
Yeah.
Just say, hey, just get started. Just set it as this, forget about it. You'll grow into your income.
Yep. So you can go cold turkey and say, all right, 15%, 20%, whatever that amount is. Excuse me, 10 to 20%, excuse my cough, 10 to 20% probably should be in there. I mean, maybe more if you can do it, but less than 10%, it's gonna be tough as far as accumulating the dollars that we're talking about.
Yeah. Yep. And so the basic idea, pay yourself first, right? Even if it is just a little bit. But yeah, like you're saying, we always want to say, hey, 10, 15, 20% if you can. The reality of someone starting out and just going cold turkey and saying 10, 15%, that I've seen that more often than not. A lot of young people just kind of like, well, I absolutely can't do that, so I'm just not going to participate.
Yeah. And if you calculate if you do 1%, for most people, if you calculate what that is per paycheck, people say, oh, really? That's it? Oh, I can do that.
Right.
So yeah, start with 1. If you can't do anything, do 1, because you can do 1.
Yeah, absolutely. Anybody can do 1%.
Yeah.
That's pretty easy.
Yeah.
So, but yeah, just make it, what you don't see, you don't spend. And then the other factor of that too is, every year, if you get a raise, factoring that in as well, because everybody knows out there, as soon as you get that raise, how easy it is to grow into that race.
Yep.
Right.
Yep. Like immediately.
Yeah. Immediately.
Yeah. We get used to that pretty quickly. So that's an easy way. If you know you're going to get a raise, that's an easy way to just make that money go someplace more effective.
Absolutely.
Yeah. So it's important we don't want to just be consumers. Americans are very good consumers, by the way, which, fuels most of the economy. 70% of the economy is us just spending money on stuff. So we're already good at that. Most of us are pretty good at being consumers. So we have to kind of force ourselves to get out of our comfort zone. And at least for a portion of our money, maybe a fifth of our money, think of it as an investor, not as a consumer.
Absolutely. Yeah. So the other nice thing about the convenience factor is employer contributions. So there's about 1,001 ways that you can set up a 401k plan if you are an employer. Okay. Most of them have some kind of match and some kind of vesting schedule. So we have seen basically all of it, right? So some of the ones that you'll be more likely to see, there are some that just say, hey, there's no match. You can pay into it if you want. It's kind of your own savings thing. I would say those are very rare nowadays. Most employers need some kind of incentive in order to keep people working for them. So there's more of like on the next one, the safe harbor. So anywhere from 3 to 6%, 3% match, I would say, is pretty standard. Employers can choose to go above that as they go. We have seen, as of recently, even just this year, I've seen an employer who offered up to 8% as far as the match. That's fantastic.
That's pretty generous,
right?
Yeah.
And then there's, of course, the rules of what you have to put in order to get that full match, right? So our general rule is whatever your employer is matching, at least match that, or get the full match.
Get the free money.
Get the free money, because that's a fantastic thing.
Yeah. Maybe it's better to say it's money you earned. I mean, because ultimately you did, right? So you've earned those benefits. Take advantage of them.
Absolutely, it's there for you, and you might as well take advantage while it's there.
Yeah.
The other key thing there, actually, can you go back?
Yeah, absolutely.
Is the vesting schedule. So that's all right. So vesting means basically how long do you have to work there in order to be able to claim all that match that the employer gave you, right? So if an employer has a safe harbor plan, so this is typically your smaller employers. Safe harbor basically means that they have to put it in. They're meeting the minimum requirements for a lot of stuff. A lot of younger companies, smaller companies like this, because it's a cheaper version, has less rules. Whatever they put in is immediately yours, right? The second two, the 3-year cliff and the 2 to 6 year graduated. 3-year cliff basically just says you have to work there for 3 years. Once you hit that 3rd year, any and all matching dollars are yours, no matter what happens. Where the 2 to 6 year graded schedule, that's you have to work there for 2 years, and then every year past 2 years up to 6, you earn a bigger percentage of what they've basically paid in. So you can see easily just between these couple of things here how many different variations of this you can come out with, but that's why people like us have jobs, right? So we can kind of
True.
explain your plan to you and say, this is what this is what you have to do to get all the benefits of it. Here to help with that.
Yep. So take advantage of the free money if they're offering that. One thing to note here too, because sometimes people say, well, Josh, Jeremy, you say I should put away 10 to 20%. Should I include the match in that? We say no. So we say you should do 10 to 20% of your own money. And the reason why is that the employer matching is not guaranteed. If the economy hits a recession or that company is struggling, something like that, they can stop matching at any given time. And we've seen that happen.
Absolutely.
Maybe temporary, but still you want to get used to, and I want to get used to that money coming right out of my paycheck. It just goes directly into the 401k plan. I never have to think about it. But it's money that I budgeted that's kind of coming out of the money that I feel, in other words.
Yeah. In other words, don't bet your future on someone else's decisions.
No. Yeah.
Right.
Yeah, exactly. Not on the employer, not on Social Security. You want to be doing what you can control.
Yep. Yeah. Absolutely. So we kind of talked about this one earlier. Whether you're putting things in pre-tax or after tax kind of depends on your situation. But we can kind of see how pre-tax contributions work, what that looks like on your every paycheck.
Yeah.
Right. How it impacts you on a dollar for dollar basis.
Absolutely. So if you put $1 in, it may only feel like 90 cents or 80 cents or so. It depends on the tax bracket that you're in, which means that you get a bigger paycheck, or you can kind of repurpose that and say, okay, good, the tax advantage. That means instead of, maybe I thought I could only do 1% of my pay, but if I'm going to get that tax advantage, maybe I could actually do 2% of my pay and still not really feel it. It might actually not feel like a difference in paycheck. So that's important.
Absolutely. And then when does it make sense to do Roth stuff, right? So we, I think, are both very big proponents of Roth in every way, shape, and form.
Prepay the taxes.
Yeah.
That's essentially what you're doing.
Really just start a big pot of money that's going to be tax-free to you and, potentially those you leave it to down the road.
Yeah.
Of course, the give up is you don't get any upfront benefit.
That's exactly right. So it feels like a whole dollar. Yeah, it feels like a whole dollar that comes out of your paycheck. Yeah. So again, you can kind of play games with yourself on this, and maybe I should just start Roth right off the bat at the beginning here, and then I won't feel it. I won't know the difference, and that's true. Once it's kind of going, you're not going to know the difference. So we've done this before. We know kind of how people think and how it affects us as well. So definitely want to look at tax advantages. If you're not sure which to do, like we talked about, do some of both. Maybe it's you put half in traditional, half in Roth.
Absolutely. And the nice thing is you don't have to set it once and then you're stuck with it. You can make that election multiple times. You can adjust it as you go. As you're in a position, what you're putting in year 1 does not have to be what you're putting in year 10 or year 20. Nice thing about those plans, they offer some flexibility.
There usually is a lot of flexibility, and we say usually just because every plan is different. So sometimes we look at somebody's plan and maybe it could be really inflexible and kind of stinks. And does that mean you shouldn't do it to get the matching? Well, you should at least get the matching. That's like 100% return on your money. So there's no investment that's going to do that, right? So if you definitely want to make sure that you get that, and then kind of consider your different options that might be outside of your employer's plan if you're not happy with what they've got.
Absolutely.
So tax deferred growth, it's an important part about looking at all of this, right? Is not just the investments, but the taxes as well. Which brings us to investments, because that's pretty darn important, especially because of that compounding effect that we talked about before.
Absolutely. So every plan has their own set of investments typically, right? And so, we've even set up some 401k plans for some companies, right? So we've been through that part of it where you have to kind of pick and choose and whatnot. But typically there's, a mix of investments in there. It allows you to kind of pick and choose, or if you have an advisor, or if you need an advisor, we do this with clients as well.
Yes.
Where we can go through this. I think a lot of people default, and especially when you're just starting out, when you're starting out and you only have $1,000 in your 401k, it doesn't make sense to own 5 to 10 funds, maybe not. But pretty much every plan nowadays has something that's called a target date fund. So basically you pick they're designed to be, hey, I'm going to retire in 2065. I'm going to pick the 2065 target date fund, and it starts out really aggressive. Well, I have a lot of time. And then the closer I get to 2065, it, starts to become more and more less and less aggressive. That's
Right.
what I was trying to say.
Right.
So getting
Set it and
closer,
forget it.
saying, yep, we're not betting the bank this close to retirement. So we're protecting this as we get closer.
Yeah. So it's a set it and forget it type investment. Does that mean that it's right for everybody? No, it's really not, because it's just a cookie cutter option. It's a default option. If you've got a fiduciary, if you've got an investment advisor, people that are doing this for you and they care about you, they're probably going to want to customize that and say, you know what, let's look at all the choices that your employer offers you. Maybe there's a more effective mix of investments, better choices, cheaper choices, ones that are more targeted for you instead of just a target date fund. Well, how about a portfolio that's actually designed for you and based off of what you're comfortable with and your risk number and your plan as far as how much we need to accumulate. So that's what we are proponents of course, for people who have an advisor. That's something that you really should be having them do. If it's not us, they should be spending a lot of time with you on figuring out all your investments, not just the stuff that you've got directly in the account with them. And that is a service we provide. It's part of what we do actually, as we look at people's plans. We actually actively manage those plans in a lot of cases, especially if there's a lot of investment choices. We do spend time on them.
Absolutely. So just like we were saying, choosing the right investments, right? Types of investments. Again, this goes towards risk, right? Is what kind of risk are you comfortable with? Obviously stocks are going to be more risky. They're a lot more volatile on the day-to-day. Bonds, save for this last year, bonds tend to be kind of that more conservative part, versus keeping everything in cash. Right. So not to say that cash isn't completely risk-free. If you consider inflation, there's something eating away at your cash at all times. So it's about finding that right mix of all of those to basically meet your financial goals, and your financial goals are different for everybody.
Right. Absolutely. And cash, when we say cash, sometimes people say, well, cash, you mean cash in my pocket, cash in the vault? No, what we're talking about, usually it'll be called a money market or a stable value fund. There'll be some kind of, they'll probably kind of categorize it as cash or money market type investment. So they tend to get a little bit lower, actually a lot lower return, but they tend to be very stable. There usually is some kind of a guarantee attached to it. So you have zero volatility, close to zero risk, but probably close to zero return too. And it used to be that was the default option in a lot of plans was cash. And so that's why they started target date funds. They kind of try to mix these different categories, stocks, bonds, and cash together. And these might be called all kinds of different things, by the way. Growth funds, value funds, blended funds. There might be all kinds of different like labels they put on these things. But don't let that confuse you. At the end of the day, it's going to come down to stocks, bonds, and cash. Even if it's called an alternative investment, well, most things are still going to be, kind of come back to those things. Right. So, and some plans have some really exotic investments too. You want to be careful, right? If you're talking about plans that have commodities or gold or cryptocurrency or things like that, that could be super high risk, way riskier than stocks that tend to be things that are a lot of volatility and can go down substantially in a very short amount of time. So I'll be very, very careful about what you're investing in, that you understand the level of risk that you're actually taking. Don't put all your eggs in one basket, but also understand the asset categories that you're putting your money into.
Absolutely.
Yeah. So your risk number, when you kind of look at the spectrum of stocks to cash, again, cash, if we had a scale of 1 to 100, cash would be close to a 0 as far as risk, but a very low return. Bonds would be probably in the 20s, 30s, maybe 40s. Yeah, depending on what kind of bonds you're looking at. And then stocks much higher, obviously going to be up in the 70s, 80s. To get beyond 80 miles an hour, by the way, an 80 risk score, you really would have to put yourself out there. Maybe if you stuck all your money in your employer stock or just, any really high risk category, again, like crypto or gold or commodities, things like that can be super high risk. And obviously all of these things can lose value. I think that should go without saying, but all these things can lose value. So it is important to understand what kind of risk you're taking. And basically, what does that look like in a bad year? Last year wasn't very good. 2022, for those of you who were not watching, it wasn't the best year because pretty much everything went down in value to some extent. Even if you're really diversified, you probably still didn't make money last year.
Absolutely. Pretty tough. I liked the point about the stock plan too. Like, a lot of companies, we work with a lot of tech workers, right? So a lot of those companies offer employee stock purchase programs, things like that. That could be a whole other webinar topic, quite honestly. But be, I guess, wary of having that concentrated position. A lot of people have made a lot of money off of restricted stock units and stock options from really good companies. But it does put you in a specific situation inside of plans like this, where all of a sudden now you have a lot of money that's in one stock.
Right.
And so instead of traveling 70 miles an hour where you're comfortable, you're actually traveling about 95. So just kind of be aware of it.
Yeah, absolutely. No matter how, not to knock anybody's company, but the reality is we can use lots of examples of companies that used to be, the biggest company in the world, the most successful company in the world, and now they're not. They might not even exist anymore.
Right.
Lots of big names. We won't even name names, but lots of big names of companies that have gone completely away or are just a shadow of themselves.
Absolutely.
Blockbuster Video, right? There's one store left, right?
One left.
In
That's right.
Oregon, isn't it?
I think
Yeah,
so.
yeah.
So the
So
last remaining Blockbuster.
yeah, so your Blockbuster stock, even though there might be still one store that might be still in business, you've still lost 99.99999% of your money.
Right.
So we laugh about that, but stuff like that happens.
It's really real.
Stay diversified.
Yep.
Yeah, understand your risk. So
Absolutely.
mutual funds are typically how you're going to be investing in a 401k. We use the term mutual fund. They might be called different things, index funds, target date funds, things like that.
Absolutely. So I think the vast majority kind of default options within most 401ks are mutual funds. And so that would be, something that has active managers who are doing it, but really it's just a mix of stocks, bonds, and cash.
Yeah.
Right. Like we were talking about.
Yeah.
Some plans offer exchange traded funds. Similar to mutual funds, there's a broad spectrum of stocks, bonds, and cash, different companies inside of there. The thing that holds it different is that a mutual fund typically has a management team that is inside of there moving things around, companies and whatnot. Whereas an exchange traded fund basically just sets up a mirror to an index like the S&P 500 or something.
Which was still designed by humans at some point, right?
Absolutely.
But they're not changing it around a lot. Yeah.
Yeah. So there's expenses that go along with all of those. But the nice thing about them is they're a quick and easy way to get automatic diversification.
Yeah, absolutely. Yeah. So any investments that you're looking at, you have a menu of choices. Most plans don't just give you any choices. So you're going to have a menu of choices that they've selected for you. And there's a lot of different companies that provide 401ks, Fidelity, Vanguard, a lot of other kind of plan providers. But within that plan, somebody decided at some point what the appropriate list of choices was. And you might look at your list of choices at your company and see that you've got 5 choices and, so an embarrassingly small number of options.
We've seen it all.
Yeah, we have. And some people have like thousands of choices inside their plan. So it really depends. But, it's certainly something you want to be very careful about, understanding exactly what you got in your portfolio, what the risk is, costs, how it actually works during a good market, a bad market. It's very, very important to have somebody in your corner that actually knows what they're doing, or you become an expert on your end. If you really think this stuff is interesting and you want to make that a hobby, a part-time job, great. We have a lot of people, probably most of our clients that come to us used to do it themselves. They kind of selected their own investments, or maybe they just had it on autopilot and were good savers. They get to the point that they want us to manage it for them.
Absolutely. And then, kind of going along with that risk, right, is investments based on objective. So when we say objective, really what we're talking about is, is this designed for growth? Is it designed to create income? Is it designed to protect what I've put in there?
Right.
And I'm not too interested in growth. I just want to make sure I don't lose a whole bunch.
Right.
Right. This is honestly just a different way of saying risk.
Yep, it is.
Yeah. How much risk am I comfortable with? How much volatility am I comfortable with? How much gain do I really want to get?
Yep, absolutely. Asset allocation is, if you've listened to the podcast, The Wiser Financial Advisor, we call this the most important investment decision. Why is that, Jeremy?
Yeah. So asset allocation, really, again, all of this stuff kind of comes down to, risk, how much you're willing to bet with it, how much you're comfortable living with, but ultimately what your financial goals are,
right,
and where you're trying to get with this money. What's the purpose of this money? And what's the purpose of anything you invest? To create income.
It is,
right?
Eventually, either now or later. Yeah,
absolutely. So, how do you split it up? So basically, is this for saving? What's my time horizon? How much risk am I all involved in? All these factors really come into, okay, so I'm comfortable with this, and this is what my goal is. what does that mean I should have in all of these buckets?
Yeah, absolutely. The reason why this is so important is that mix of stocks, bonds, cash, which would be different for everybody. Everybody has a different risk number. We highly recommend you. We've got a tool on our website. We'll mention in a second here that allow you to figure out what that risk number is. But that risk number largely is going to be what determines the mix of these things, right? Between growth investments, bond investments, income investments. It's really going to be about you and what you're personally comfortable with.
Absolutely.
Yeah.
And that's, everybody, the other thing to keep in mind is that that's not always set in stone either.
No,
So
change.
that can change over time, what
Mhm.
you're comfortable with, how much risk you're happy taking and whatnot, that can shift.
It can. And
So-
I will mention, because sometimes people have this misconception that it's all about age. It's all about how old you are. In fact, there's these
Not
old
at all.
rules of thumb that, you should have, your age minus, whatever, right? And
Yeah.
that's how much stocks you should own, which we think is baloney.
Yeah.
Baloney, cookie cutter approach. We have conservative investors that are very young. We've got aggressive investors that are very old. It's all about temperament, what you're comfortable with. Think of it like turbulence, airplane. You get on an airplane. I don't care how good the pilot is, how big the plane is, how clear the skies are. Some point, especially if you're landing in Denver, there's going to be turbulence.
Yep.
That doesn't mean the plane's going to crash,
Right.
but there's still going to be turbulence, and it's not comfortable. Nobody likes it.
And some people can be on a plane with turbulence and take a nap.
Right.
And others are white knuckling it the whole way.
Yep,
Right,
absolutely. So
just
that's
depends.
a good example of kind of getting through this. Again, plane doesn't have to crash to get turbulence. Turbulence doesn't cause plane crashes, but it can be very uncomfortable, especially when it gets really bad. And during a recession, which we might be in, we might be going into one, right? It's everybody's opinion, right? As far as what kind of economy we're kind of going into, or how bad things are going to get. But ultimately, that can cause a lot of volatility, a lot of turbulence.
Mhm.
Yeah.
Absolutely.
Got some great tools. We're going to send a workbook out to those of you who are attendees. And for those of you who were attendees after the fact, we won't know that necessarily. We'll just see that there was a view, but if you'd let us know, you can email us at communications@keystonefinancial.com. We've got a workbook, some of these worksheets. I'll also throw out that risk number is on our webpage for free. Doesn't cost you anything, and we're not going to, have salespeople call you up and bug you, that sort of thing. Just go to keystonefinancial.com, scroll down the page. There's a button that says find out your risk number, and there'll be a short assessment. You'll take that assessment and it'll actually give you your risk number. So I think that'll be pretty helpful for a lot of people that really want to get a quick answer. Literally, will just take you a few minutes.
Absolutely. It's only about 7 or 8 questions, I think.
Right.
All done and
Absolutely.
said, but I always find it's a really good exercise to just kind of put the thought of what risk means or what volatility means and what you're comfortable with. Might phrase it a little bit differently than you have in the past.
Yeah.
So,
Yeah, absolutely. So,
yep.
we have people take that periodically, even existing clients that already took
Absolutely.
it before. Yeah, take it again, get a good feel for your risk level, and maybe because of the market or the economy or something's changed and your risk number does change. So definitely keep us apprised of that. Quick summary here, retirement has changed. It's longer than ever. People are living longer in general. I know there's some studies that have come out that say, hey, the last few years, though, it's not the case. There's been, overdose deaths and COVID and all that stuff. So maybe life expectancy has been affected. But for planning purposes, we want to plan on people living a long time, having a long retirement. So it's very important. It means that it's that much more expensive. Most people will need a large nest egg to retire comfortably, probably in the millions. For most people, it's probably going to be in the millions. How many millions will depend on how much you want to spend. And
Absolutely.
we will figure out that number for you. Social Security is just a safety net. Various opinions on Social Security, but I don't think there's any disagreement that it's got to change. The program can't stay the way it is forever. And it's something that you cannot control other than voting. There's nothing you can control about that. So put yourself in the driver's seat, do more of your planning based off of your own investments, your own savings. That's what's going to make the difference. Compounding in time can work for you, and it will. It's inevitable over time. Math works, and we like math, and compound interest is one of the most amazing things. I think it was Einstein, wasn't it? Said it was the greatest miracle he's ever seen is the effect of compound interest. So we agree with Einstein.
Absolutely.
Yeah, retirement savings plans are convenient. They have tax advantages, and that's primarily why we want to use them, right? Because there's very little example of anything else out there that will get you those kinds of advantages. And you do get investment choices within the plan. We talked about 3 key factors contributing to your asset allocation, which is the most important investment decision. Just that asset allocation makes a lot bigger difference than anything else you would do, as far as did you pick the best stock fund or something like that. Just being in stocks to begin with is going to make the difference, not whether you always pick the best investment choice within that plan.
Absolutely.
So,
Yeah.
yeah. So enroll today, right? Enroll in your plan today. We're not salesmen for your plan. We just think that it would be a good idea if you have a plan and you haven't enrolled, start with 1%. Just start, get your free money
somewhere.
Yeah, absolutely. Yeah.
Yeah. And the other thing is too, is that, again, we've seen so many of these plans, right? We've seen everything from brand new startup companies to Fortune 500 companies and various things between them. We touched on, I would say, most of the basics of most plans today, but there are some other plans, especially if you are at the executive level or nearing the executive level, where even bigger things like deferred compensation plans, they can kind of get added in on these, right? So any specific questions like that, come find us, let us know. We'd be happy to walk you through the plan, what it looks like, what it means, if you're eligible for it, et cetera, because all of these can be very specific to you and to your company. We're here to help.
Yeah, you don't want to leave money on the table. I think that's the key, especially if there are benefits that you're being given. You want to make sure that you're taking advantage of them from a dollar standpoint, but also from a tax standpoint, because sometimes these things can have big implications. Ultimately, you want income off of this stuff. That's why you're investing or why you're getting these things, because someday you want retirement income.
Yep. And never pay more taxes than you absolutely have.
No, absolutely. Big piece of it. For those of you who are on the other end of things, some people might just be starting out. That's great. For those of you who have accumulated over a lot of years, congratulations. You're probably closer to financial freedom. We do want to turn that into an income source. And a lot of what we do, a lot of the conversations we have with clients are about cash flow, about planning for spending. Where's the money going to come from? How do I invest the money? And when can I retire? Certainly that question comes up a lot. And again, how much money do you need to have? How much
do I have enough money to
right,
do this?
right. We like math. Math tends to answer a lot of questions.
It really does. And that's what we're here for. So please use us as a resource.
Any questions that you've got along the way, let us know. Easy to contact us, by the way. We will get back to you quickly. communications@keystonefinancial.com. The email addresses for us individually, we'll make them public, right? We'll give you an inside line to us. Josh@keystonefinancial.com, Jeremy@keystonefinancial.com. Our website is keystonefinancial.com. And another resource for you, if you haven't paid attention to it recently, is go out to the podcast. Just go to wiserfinancialadvisor.com. We cover a lot of different topics on that as well, that different than what we're talking about here. So certainly a lot of current events, things that are going on, inflation, economy. We cover a lot of those events on there as well.
Yep. We love our educational content. So please dive in.
Yep. All right. Do we have any questions, Jeremy, at the end here? I don't think so.
We do not have any questions. No, we must have done too good of a job.
We did. I'm sure it's quite possible, but we want to be here as a resource for you. Certainly, we thank you for your business. Thank you for your attention today. We want to be a resource for you, but also for any coworkers, neighbors, friends, people that you care about and that need help. Send them to us. We will answer their questions. And sometimes that's all we need to do, just answer some questions. Other people might be looking for a relationship and they want to hire somebody like us, somebody who's an independent fiduciary that's going to be doing comprehensive financial planning. That's a mouthful, but comprehensive financial planning means that we're not just talking about investments. We're talking about this stuff, about taxes, employee benefits,
cash flow,
Social Security, Medicare. We touched on a bunch of stuff today, but as you can imagine, the financial world is pretty complicated. We think that's fun. It's a great big puzzle and it changes every day. Not only because of the market and the economy and the laws and so forth, but your life changes. That's the fun for us is that we get to be part of this with you and be on the journey with you. So thanks for your time. Thanks for your attention. Anything else that you can think of, Mr. Busch?
Not right now. Reach out to us if you have questions. We are always here to help out.
All right. Great. Have a great weekend. God bless.
Take care.